Hi, thank you for joining me today. Today is Monday. I hope you're having a fabulous day. It is Mortgage Monday, where I talk about mortgages once a week on Monday. I make Monday my dedicated day of the week to talk about to the first-time home buyers that are in the market thinking of buying a home, and they want to know all the information they need about mortgages. There's three ways of acquiring real estate property. A is to buy outright with cash, have enough money to buy a home. 2, you have finance, going to a bank, qualify for a loan, get a mortgage for 30 years. Or 3, you could inherit the property, transfer your name to the title, pay inherited taxes, and life is good. So I'm talking about the second one. I'm talking about if you don't have enough money to buy a home outright, but you do have enough money to put a down payment, an earnest money deposit, and closing costs, but needs help to buy a house through finance. The good news is the Fed has lowered the interest rate, so this may be a good advantage for you at this moment in time. So let me talk about the basics. This is for my home buyers, first-time home buyers, and they really want to understand the process. So talking about the very beginning, about the terminology, the words that you're going to hear in the real estate, so for you to be familiar with it and have an understanding. I have my first word is mortgage. A mortgage is a loan to buy a home or real estate, a loan that is paid back over time. That's like 15 years, 30 years, 40 years, depending which one you want. And home or the real estate serves as a collateral for the mortgage loan. You get a mortgage and your house is a collateral to make sure that you pay, because it's a long-term commitment. It's a 30-year commitment, and your house will have a lien on it to the day that you pay off your mortgage, and that it's always your ultimate goal is to live a free and clear home that you owe no money to anyone. But if you need a loan, not a problem, but these are the things that you need to look for. Then the second one is a mortgage banker. What is a mortgage banker? Mortgage bankers are lenders who originate, process, and underwrite and closes mortgages, typically using their own fund. These are the people behind the scene that process the loan and actually are the ones to originate, gives you the money so you could buy the loan, the house. The third word is mortgage broker. A mortgage broker is an intermediate party that brings together buyers and lenders together. They're the one that does the application process, explains to you all the terms and conditions and all the products that is available to you. There's many products, so there's always something right for you and your family. So that's why a mortgage broker is so needed, and they're very valuable in this process. These are the first people that you want to meet to get qualified and to feel comfortable enough before you go to the second step, and that's looking and preview homes. The fourth word is finances. Finance is a simple way of paying for something, and real estate finances is a typical discussed in association with payment for homes or other form of real estate. Finances is really a terminology that we use for mortgages, somebody with a loan. And then the next word is collateral. Collateral in real estate is typically refers to a home or real estate purchase by a borrower of a loan. You are the borrower, and the lender is the one, the bank is the lender lending you the money. So collateral is typically something that you purchase. Refer that of a real estate purchase or borrow up for a loan. 6 is credit report. Shows a breakdown of a person's credit history of how the person has repaid loan in the past. Your credit report is very important. It is critical to have accurate, current information about you. It is a psychological way of you handling money, how responsible you are with your payments, with your bills. Do you pay on time within the 30 days? Do you pay the minimal, full amount? Or do you pay in between? Or do you have collection on your credit? You miss 30 days, 60 days, 100 days, 120 days, or you're ready in collection. Have you been through the foreclosure? Have you been through bankruptcy. All that counts, and that will come out in your credit report. So if I was you, you could go and get your free credit report. There's different websites. You could get your free credit report once a year. Look at it, make sure that's accurate, that has all the right information. If you need the website, let me know in the comments and I'll let you the link so you could take your credit report, look at it. Make sure that everything that says about you is accurate, because the bank will make a decision based on that information. Credit score is what is assigned based on a person's credit report. A higher credit score is achieved by the history of timely, consistent payment on the past loan. The higher the credit score makes it easier not only to secure mortgage loan, but also to get better terms of loans and rate. Okay, so a credit report tells you what's called a FICO score. A FICO score is a score that gives the bank and everybody else that pulls out your credit, where are you? The lowest score you may have can be up to 400. And nobody gives you a loan if you're 400. And it goes all the way up to 900. That is excellent, perfect, perfection. And that's where everybody starts. Everybody starts in that category, in the 900. And then life gets messy, it gets complicated. And then that's how our number gets changed. The more you have inquiries, the more credit card you have under your name, that 900 starts going down. If you get a mortgage, it goes down. If you have a lease in your car, it goes down. If you have like 23 credit card opens with balance, that number goes down. So what is your FICO score? You could look for it. You could get it and you understand it and know where you're at, because the higher the score, the better terms and conditions the lender will give you, better interest rates, better closing, better terms, because you're responsible, you're accountable. We know we could trust you with the loan. The lower the credit score is, the more challenging, the higher risk you may be. It means that you don't put paying your bills a priority, or maybe you're getting stuck with payments every month, or not enough money, too much debt, not enough income. And that could be complicated in anybody's situation. And then you have the credit score. Then you have the credit bureau that collects credit history, the consumers that ultimately result in a person's credit score. There's only three major bureaus: TransUnion, Equifax, and Experian. Those are the three that gathers our information, our history, our payment, and they're the one that puts it in the system. And that's what the bank looks for. Number 9, points or discount points. It is a way for the borrower to pay down an interest on a mortgage loan in advance. Each point is typically equal to 1% of the total loan amount, and each point is generally reduces interest rate by 1/8 or to 1/4 of the percentage, depending on the borrower and overall terms. You will hear this in the marketing department. On the new home construction, we pay down, and that is what they're saying. Some of the terms are they pay down the interest rate today. Let's just say the interest rate today is 6% or 7%, and you go to new construction to grab you as a buyer. They say, listen, I know today's market, it's hard for you to buy a mortgage, but if we could buy down your interest rate, right, discount point, that makes it from a 7 to 6, and the terms could be for 1 year, 2 years, or the life of the loan. That's why it's so important to have your professional real estate agent if you're considering buying new construction, to make sure that all the terms and conditions are really there and you understand it. Number 10, escrow. It's a financial arrangement in which the account is set up between the borrower and the lender that distributes a bundle payment for mortgage principal, interest, property taxes, and hazardous insurance. FHA loans typically require an escrow account less than 20% down. If you're not able to put 20% down, then it's what we call it a PITI, principal, interest, tax, and insurance. And they will escrow each month within your payment. They will separate your hazardous insurance policy and your property taxes and make sure that at the end of the year you could pay it in full and not have any delay or have any liens on your house. So that's good. If you're allowed to and you're able to put more than 20% down, then you don't need to put a PITI. You could pay your own interest, your own insurance, and your own taxes. So that's one of the terms as well. And the last one is earnest money deposit, EMD. It is initial deposit made by the buyer to show seriousness of the intent to purchase a property from the seller. Typically, it's like 1% to 3% you put down, and that's part of your cost also, and it will deduct the total amount what you're going to pay at the end. So let's just say you put $1,000, you're buying a house, you know, that's $1,000 less, and that will be the balance what you pay at the end at the closing, if it's cash or finance. So those are just basic terminology that you will hear if you're about to buy. So let me know if you're in the market to buy. I'm your local professional real estate agent in Marion County, Florida. If you have any question, please let me know so I could help you out and give you more information. And I will see you tomorrow. Tomorrow is Tuesday, and that is Tours Tuesday, where I tour some new construction community and give you the ins and outs. Well, make it a blessing day and take care. See you tomorrow. Bye.